In Chapter 2, Income, Benefits, and Taxes, we're going to take a look at three sections within this chapter. The first is earned income and benefits. The second will be unearned income and payments. And the third will be taxes and other deductions. Earned income and benefits. I have two learning objectives for you today. List and discuss types of earned income, such as wages, salaries, tips, and commissions. And the second one is to describe employee benefits and their role in employee compensation. Let's take a look at the first source of earned income. First, we need to decide or determine what earned income means. Earned income is any income you receive from working. It includes wages, salaries, tips, commissions, and net earnings from self-employment. All types of earned income are subject to income taxes and Social Security taxes. A tax is a required payment for the support of a government. The tax may be based on items such as earnings, property values, or the sales price of an item. Think payroll taxes, think property taxes, and think sales tax. More information about taxes will be talked about later. So let's look at wages. Wages are earned by employees who are paid for each hour worked. In New Jersey, we have a minimum wage of $8.44 at the time of this recording. The lowest pay rate allowed by law for each regular hour of work is the minimum wage. Again, in New Jersey, it's $8.44, but in other parts of the country, effective 2015, was $7.25. But there are many states in this country who have higher minimum wage laws than that $7.25. What happens when you work overtime? Well, first you have to decide, you have to understand what overtime is. Overtime is pay in addition to what you work for regular hours. And know what regular hours are. Regular hours are 40 hours. A lot of times students confuse regular hours with just an 8-hour, but it's actually 40 hours. So make sure you remember that. 40 hours are what's considered a regular work week. And then let's say, for instance, you work 50 hours. 10 of those hours would be paid at overtime pay. Salaries. In salaries, some people work for what's called a set salary. So it doesn't matter how many hours they work, they get paid a set salary, whether it be paid by that month or by the year. Unlike people who work for hourly wages, they don't have to keep time cards. So it's a little bit different there. And generally they work a little bit more than 40 hours a week. They have a lot more flexibility in their work schedule. We're going to take a look at tips and commissions. So a commission is a set fee of or a percentage of a sale paid to an employee instead of or in addition to a salary or wages. So let's say, for instance, you're a car salesman, and for every car you sell, you get paid $500. That incentivizes you to sell more cars because you're being paid a commission. More often than not, a salesman on a car dealership is not paid a base salary, which means that the only income they earned is from that commission and commission only. Another one is tips. So we talked about in class about waiters and waitresses when we were looking at jobs in the job market. As a salaried person gets a set amount of money for the year. The wage earner gets a set amount per hour, and the commission may get a set amount per sale or per unit sold. But tips are a little differently, work a little differently because you do have a minimum wage, and that minimum wage, I believe, it's going to vary throughout the states, but at this time I believe it's about 213 to 215 in New Jersey. But each employer will have a different amount, at least. So what are employee benefits? Full-time workers usually have benefits provided by the employer. Benefits are forms of compensation in addition to salary or wages. Common benefits provided by employers include things like paid vacation, paid holidays, there's health insurance, but sometimes when your employer offers health insurance, you're gonna have to pay part or sometimes even all of the cost. Benefits are important to workers for a number of reasons. They increase the overall value that a worker receives from a job. Disposable income refers to the money that a person has available to spend or save after taxes are paid. Money received or saved from certain benefits increases the worker's disposable income. So let's say, for instance, your employer offers to pay 50% of your health insurance premium. That means you would have had to buy health insurance because that's the law. And that 50% savings for that health insurance premium gives you more disposable income. So you can save or spend that extra money. There's also pay without work. So let's take a look at that one. Sick leave is when you get paid when you're absent from work and because you're sick. It's paid time away from work due to an illness. There's also personal leave, and in personal leave, paid time away from work for personal reasons. So let's say, for instance, you're not sick, but you need a day off to um, I don't know, attend to Black Friday because you have to work on Black Friday. That's a personal reason. It's not a sick day. It's not really a vacation day. You get a personal day. Most employers offer 1 to 3 days per year for personal leave. Another one is insurance. Employers with more than 50 employees are required by law to offer health insurance. The price paid for health insurance is called a premium. That's what you pay every month. Some employers will pay the full premium as a benefit to their employees, but more commonly today, most will share the premium cost with the employee. There are other types of insurance such as group life insurance, disability insurance, and workers' compensation. The health insurance, group life insurance, and disability insurance are generally something that you pay. They're not always portable, which means you can't always take them with you when you leave that employer. The only one that the employers are required by law to provide you with, and they pay for it, is called workers' compensation, and that's an insurance plan that employers are they have that covers in the event that you're injured while on the job. There's also health spending accounts where you can put away some pre-tax money, which decreases your net income over the year. There's a health spending accounts are another benefit that employers offer. And with the health spending account or health savings account, employees set aside money to help pay for the qualified medical expenses that are not covered by insurance. That includes deductibles and copayments. Contributions to these accounts are pre-tax and they are tax deductible. But one of the downsides to this is that if you don't use this by the end of that health spending year, then you lose that money. So it's kind of one of what they call use it or lose it. It cannot be carried forward to the next year. So that's always something that you want to think about if your employer offers that to you. Other employee benefits that you'll receive or you can receive are things like the 401k plan. That's a retirement plan, and that's a plan which a portion of your income goes into an account for your retirement. So remember, we talked about you're probably going to be working 46 or more years. And some companies will offer pension plans that are paid entirely by the employer, but there are fewer companies that do that. So as they phase out this practice of pensions, employees have to create their own savings plans for their retirement. So a 401k plan is probably the most common and most popular at this time. There are other things that employers will do, and they're called incentives. And an incentive is used by employers as a way to encourage employees to shoot for higher levels of performance. These are the things that they give to the rock stars in the company. So they share in the company's success through these incentives, and they're motivated to achieve the company's goals. Companies offer a lot of different types of incentives, and I'm just going to talk about two that are the most common. The one of them is profit sharing, where they may pay a bonus of a specified percent of the employee's salary if the business meets or exceeds their financial goals. Some companies allow employees to buy stock in the company at a reduced price, which is lower than the market value. Those are called stock options. They can be deducted from the employee's pay, and it's a convenient way to acquire stock. Another one is perks. So In addition to wages or salary, the standard benefits offered as part of an employee's compensation package, many companies offer extras called perks to their employees. There are social and recreational programs, employee discounts on the company's products and services, fitness centers, wellness programs, flexible scheduling, on site childcare, facilities, mental health counseling. Those are just some of the examples. Another perk commonly offered is tuition reimbursement, and this is the one where you need to perk up your ears and listen. Some companies pay for the cost of classes or training related to the worker's job. And there are also more companies today are now offering this as a price matching, where if you pay $100 towards your student loans that month, they'll also pay $100 towards your student loans as an incentive or a perk for the job.